In the words of Warren Buffett, a renowned investing guru, you only find out who is swimming naked when the tide goes down. Buffett's statement emphasizes the significance of applying core investing principles during weak economic environments. When the economy is thriving, it is easy to overlook caution and assume that all investment options will yield positive returns. However, it is during times of economic turmoil that investors truly understand the importance of these principles. So today, I'll take you to insider investment principles that will make you rich. If you're new to the channel, hit that subscribe button and that notification bell icon so that you don't miss out on any of our video updates. Plus, it helps us spread the ThriveWise love to help more people thrive wisely. Now, let's begin. Principle number 1. Invest early. Research has consistently shown that investing early is more effective than waiting for a lump sum to invest. Starting with whatever funds you have available and gradually building your portfolio enables you to benefit from the power of compounding. Compounding refers to reinvesting your earnings to generate further gains. By investing early, not only do you earn returns on your initial investment, but you also accumulate capital gains, interest, and dividends. Delaying investment decisions by just a couple of years could potentially result in significant financial losses. Principle number 2. Diversification. The art of diversification is a crucial aspect mastered by most successful investors and wealth managers. Never put all of your eggs in one basket is a wise adage to follow. Surprisingly, common sense is not always common when it comes to investing. Diversification is a straightforward concept that involves selecting multiple investments instead of just focusing on one. By diversifying your portfolio, you effectively mitigate risk. For instance, if you invest solely on one company that goes bankrupt, you risk losing a substantial amount of money. However, by spreading your investments across various assets, you can limit potential losses. Historical data shows that different asset categories seldom move in the same direction simultaneously. Thus, when stocks decline, bonds may remain stable or experience different fluctuations, ensuring that your losses are minimized. Principle number 3. Have a personal financial roadmap. One of the first principles of investing is to thoroughly understand your financial situation. This step becomes crucial, especially if you have never created a financial plan before. Evaluating your current financial position, determining your risk tolerance, and establishing clear goals are essential aspects of this process. Whether you seek professional guidance or develop the plan independently, honesty is paramount. Acknowledging the uncertainties associated with investments is vital, as it is not guaranteed that you will regain your initial investment. Nevertheless, a well-drafted financial roadmap significantly increases your chances of success. Principle number 4. Cash is the king. The pandemic has vividly demonstrated the importance of having a cash reserve. Before embarking on any financial plan or investment journey, it is imperative to establish a cash reserve. This reserve should ideally cover 3 to 6 months' worth of expenses. Begin by listing down all of your expenses and their respective amounts to gain a comprehensive understanding of your monthly financial obligations. Those who had established cash reserves before the pandemic struck were able to weather the economic turmoil relatively unscathed. Their reserves served as a lifeline during the turbulent times, ensuring their financial stability and providing a buffer against unexpected emergencies. While we have no control over economic changes, we do have control over our emergency funds. It is vital to allocate and store cash reserves in a safe and accessible manner, ready to confront any unforeseen changes or financial emergencies that may arise. Principle number 5. Leverage is key in building wealth. To build substantial wealth, leverage becomes a crucial tool. Being limited to your own resources will inevitably restrict your potential for massive wealth creation. Leverage can take various forms, each offering unique advantages. Financial leverage involves utilizing other people's finances to expand your pool of available funds and generate greater wealth. Time leverage entails capitalizing on the available time of others since you are confined to a mere 24 hours a day, with a significant portion spent sleeping. By leveraging the time of others through delegation and outsourcing, you can achieve more in a given time frame. Knowledge leverage involves tapping into the expertise of individuals who possess greater knowledge and understanding of investment strategies. Recognizing that you don't know everything and seeking insights from experts can significantly enhance your investment decisions. And lastly, systems and technology leverage refers to adopting established systems developed by others that have proven to be more effective and efficient. Embracing technology and leveraging existing systems can streamline your investment processes and maximize your returns. Principle number 6. Be vigilant of fraud. Fraudsters and scam artists are pervasive in the investment landscape, constantly seeking their next unsuspecting victim. They often capitalize on highly publicized news items to lure investors with seemingly irresistible opportunities. However, most of these opportunities are too good to be true. To protect yourself from falling victim to these scams, it is crucial to exercise caution and skepticism. Ask probing questions, request official documents, and thoroughly investigate any investment opportunity before committing your hard-earned money. Involving a lawyer or financial advisor to evaluate entities and investments can provide an additional layer of security. By maintaining vigilance and conducting thorough due diligence, you can mitigate the risk associated with fraudulent schemes. By the way, if you're enjoying this video, please take a moment to like and subscribe. It really helps us spread the ThriveWise love, so we can help more people thrive wisely. And going back, Principle 7. Keep an eye on fees and taxes. Brokers charge fees for every trade made, and these commissions can vary between 2% to 5% per transaction. It is crucial to evaluate and compare brokerage fees before making investment decisions to ensure they align with your financial goals. Additionally, taxes on capital gains can significantly impact your overall investment returns. Before investing, it is essential to understand the tax regulations within your jurisdiction and consider the potential tax liabilities associated with your gains. By carefully monitoring fees and taxes, you can optimize your investment returns and minimize unnecessary costs. Principle number 8. Conservative bonds are a safe haven. During periods of soaring markets, many investors become fixated on high-flying technology stocks and may overlook the importance of quality fixed income sources. While there is nothing inherently wrong with pursuing growth-oriented investments, it is essential to recognize that market turbulence often follows periods of significant market gains. Bonds play a crucial role in portfolios by providing a cushion during turbulent times. They offer investors the ability to withdraw from an asset that has not experienced a significant decline in value. Dismissing bonds as a core investment strategy is short-sighted and fails to appreciate the stability and diversification benefits they bring to a well-rounded portfolio. Principle 9. Boring always beats exciting. Human nature is drawn to excitement and novelty, often leading investors to chase the latest fads or seemingly groundbreaking ideas in the market. However, there is a fine line between exciting opportunity and a viable investment. Unfortunately, many investors fail to distinguish between the two. Often, excitement is packaged in the form of the latest business model, revolutionary technology, or exclusive deals. Instead of focusing on the fundamentals, investors are swayed by hype. It is crucial to remember the importance of separating emotions from investment decisions to avoid being lured by short-term excitement. It is advisable to stick to traditional, boring investments such as investment stocks, index funds, blue-chip stocks, or high-grade bonds. While you may miss out on the next hot initial public offering or the IPO, you can secure stable returns and mitigate unnecessary risk. Principle number 10. Returns and risk go hand in hand. Every investor seeks the highest return with the least amount of risk. However, finding the right balance is challenging because higher returns often come with higher risk. Risk can manifest in various ways, such as illiquidity, poor credit quality, or excessive leverage. Illiquidity refers to the inability to convert an asset into cash quickly. Economic conditions also play a significant role in determining investment returns. As an investor, it is crucial to remain vigilant and recognize that every lucrative opportunity carries a certain level of risk. Carefully assess the risk involved and ensure they align with your risk tolerance and investment objectives. Principle 11. Dollar cost averaging. Dollar cost averaging is a strategy that involves consistently investing a fixed amount of money into investments at regular intervals, regardless of market conditions. This approach helps mitigate the impact of short-term market volatility by spreading out the investment over time. Emotions often cloud investment decisions, and allowing emotions to drive investment choices can lead to poor outcomes. By setting up an automated investment plan and adhering to a consistent investment schedule, emotions are effectively removed from the equation. Dollar cost averaging eliminates the temptation to time the markets and enables investors to build wealth gradually over time. This disciplined approach reduces the risk of making impulsive decisions based on market fluctuations and provides a long-term perspective on investing. Principle number 12. Rebalance to make money. Rebalancing is a proactive strategy based on the principle of buy low and sell high. It involves adjusting the allocation of assets within a portfolio to capitalize on market changes. As different investments perform differently over time, their weights in the portfolio can shift. Rebalancing allows investors to sell positions that have increased in value and buy positions that have declined, thereby maintaining the original asset allocation in line with their risk tolerance. Regular portfolio rebalancing helps investors maintain a diversified and aligned investment strategy. When certain investments outperform others, they may become overweight in the portfolio, increasing the risk exposure. Rebalancing enables investors to make profits from the investments that have done well and redistribute them into underperforming assets. This disciplined approach ensures that the portfolio remains aligned with the investor's long-term goals and risk tolerance. By actively rebalancing the portfolio, investors can effectively control risk and potentially capture gains from market movements. It requires periodic assessment and adjustment based on investment objectives, market conditions, and a desired asset allocation. Rebalancing should be approached systematically and not driven by short-term market fluctuations. It is a long-term strategy aimed at maintaining a well-diversified portfolio and staying true to the investor's risk profile. Well, that's basically insider investment principles that will make you rich. And thank you guys so much for watching today's video. And hey, it seems that YouTube thinks that the next video can completely transform your financial situation. Watch it to find out whether they're correct. And please don't forget to click the subscribe button to see more videos on how to thrive wisely. Till next time.